Lehman Brothers looked untouchable. It was one of the most famous names on Wall Street. A 158-year-old firm, a giant in finance, a symbol of power, prestige, and money. And then it collapsed. Not slowly, not quietly, not with warning signs obvious to the public. It fell apart in a way that sent shockwaves through the entire global financial system. Over $600 billion in assets, gone into bankruptcy. One of the largest corporate collapses in American history. And the scariest part is this: Lehman did not collapse because one small thing went wrong. It collapsed because the entire machine was built on risk, leverage, weak assumptions, and the belief that housing prices would keep rising forever. For years, that belief made people rich. Then it destroyed them. This is the story of how Lehman Brothers became one of the biggest collapses in financial history. Lehman Brothers started as a small business in the 1800s. Over time, it evolved into a major investment bank. By the 2000s, it had become one of the most powerful firms on Wall Street. It made money in many parts of finance, but one area became especially important: mortgage-related investments. That was the engine. During the housing boom, banks and financial firms were making enormous profits by creating, packaging, buying, and selling mortgage-backed securities. The basic idea sounded simple. Banks made home loans. Those loans were bundled together. Then they were turned into investment products and sold across the financial system. As long as homeowners kept paying and home prices kept rising, the machine looked brilliant. Money kept flowing. Deals kept happening. Bonuses kept growing. And because everyone around them seemed to be making money, the risks started to feel normal. That is how bubbles become dangerous. Not when everyone is scared. When everyone is comfortable. Lehman leaned deeper and deeper into this world. It bought huge amounts of mortgage-related assets. It depended heavily on short-term funding. And it used massive leverage. Leverage is one of the most important words in this story. Think of leverage like trying to lift something huge with a small amount of your own strength. It can make you look powerful. It can make your returns look bigger. But if the weight shifts the wrong way, it crushes you. That is what happened to Lehman. The firm had borrowed enormous amounts relative to its own capital, so even a relatively small decline in asset values could become deadly. If you own something with mostly your own money, you can survive a drop. If you own the same thing with borrowed money stacked on top of borrowed money, a drop can turn into a disaster. And that is exactly what the housing market eventually delivered. When home prices stopped rising and mortgage defaults started climbing, the value of mortgage-linked assets began to crack. At first, many people wanted to believe the damage was contained, that the problem was temporary, that the market would recover. But bad loans do not become good loans just because people want calm. As defaults increased, the securities tied to those loans became harder to value, then harder to sell, then terrifying to hold. And once trust starts disappearing in finance, things can unravel very fast. Because Wall Street does not run only on money. It runs on confidence. If firms believe your balance sheet is solid, they keep lending to you. If they believe your assets are real and liquid, they keep trading with you. If they believe you can survive tomorrow, they help you survive today. But when that trust breaks, the oxygen leaves the room. Lehman had a giant problem now. Its assets were under pressure. Its leverage was dangerous. And the market was starting to question whether the firm was actually worth what it claimed. That question is deadly. Because in normal times, an investment bank can fund itself by borrowing short-term from the market again and again. But if lenders stop trusting you, that funding can disappear almost overnight. And when your business model depends on constant access to funding, that is not just bad. That is existential. Lehman tried to calm the market. It announced plans. It talked about reducing exposure. It tried to raise confidence. It looked for ways to survive. But by that point, confidence was already leaking out of the system. Investors, counterparties, and markets were watching one question: who is holding the losses, and how big are they really? That uncertainty became poison. There were also serious concerns around how firms were presenting the strength of their balance sheets during this era. One of the terms often associated with Lehman later was Repo 105, an accounting maneuver that helped temporarily move assets off the balance sheet around reporting periods. The effect was simple in spirit: make leverage look lower than it really was at key moments. That matters because perception matters in a crisis. If a firm looks healthier than it is, outsiders may underestimate the danger. If leverage appears lower than it really is, the market may be slower to react. But that does not remove the risk. It only delays the collision. And when reality catches up, the loss of trust can become even worse. By 2008, the housing crisis was no longer a warning sign. It was now a full-blown financial emergency. Bear Stearns had already collapsed earlier that year. The system was shaking. Credit markets were tightening. Fear was spreading. Lehman needed a solution. The obvious hope was a rescue, a merger, or some type of deal that would keep the firm alive. There were talks. There were negotiations. There were desperate efforts to find a buyer. But no clean rescue came together. And then came the weekend that changed financial history. In September 2008, Lehman Brothers filed for bankruptcy. That filing became a global signal that this crisis was far worse than many people had wanted to believe. A 158-year-old Wall Street giant had failed. The number was staggering, over $600 billion in assets. The symbolism was even bigger. If Lehman could fail, who was safe? That question ripped through the financial system. Markets panicked. Credit froze. Institutions stopped trusting each other. The crisis intensified worldwide. This was not just about one company anymore. Lehman's collapse helped turn a severe financial problem into a full-scale global crisis. And once panic spreads through the plumbing of the financial system, normal business becomes almost impossible. Companies need credit. Banks need trust. Investors need functioning markets. Lehman's failure damaged all three. Money market funds came under pressure. Major institutions faced new fear. Governments and central banks were forced into extraordinary actions to stabilize the system. The collapse became one of the defining moments of the 2008 financial crisis. Now here is the psychology of the collapse. Lehman did not look weak in the way people imagine weak companies looking. It had prestige, history, talented people, serious infrastructure, a famous name. That is why collapses like this are so dangerous. People confuse size with safety. They confuse brand with strength. They confuse survival up to this point with the ability to survive what comes next. But leverage changes the game. When a firm is highly leveraged, it does not need total destruction to fail. It just needs enough pressure to make others stop trusting it. That is the hidden terror of financial fragility. Things can look stable right up until the moment they are not. Lehman was not the first sign of the crisis, but it became one of the clearest symbols of what happens when risk is built into the foundation. A lot of people like to imagine corporate collapses as stories about one evil person, one obvious fraud, one easy villain. Lehman is more frightening than that, because this was also about system design, incentives, risk models, dependence on short-term funding, overconfidence in rising asset prices, and a market structure that rewarded growth while underpricing catastrophe. That is a much more dangerous lesson, because systems fail when too many people benefit from pretending the risk is manageable. And that lesson does not only apply to Wall Street. It applies anywhere leaders chase short-term upside while ignoring what happens if the assumptions break. So what are the executive lessons here? First, Leverage can make a company look stronger during the boom and kill it during the downturn. If borrowed money is doing too much of the work, small shocks become fatal shocks. Second, liquidity is survival. A company can look rich on paper and still die if it cannot fund itself in the short term. Third, trust is not a soft concept in finance. Trust is infrastructure. Once counterparties stop believing in you, the collapse can accelerate faster than the public expects. Fourth, complexity is dangerous when nobody can clearly explain where the risk really sits. If assets are difficult to value and hard to sell, panic gets worse. Fifth, cosmetic balance sheet improvement does not solve real fragility. You can make numbers look cleaner for a moment. You cannot fake survival forever. Lehman Brothers became one of the most infamous collapses in history because it exposed something terrifying. The system looked strong until trust disappeared. And once trust disappeared, a 158-year-old giant fell. That is the real warning. Not just that Lehman collapsed, but that a structure built on leverage, confidence, and fragile assumptions can look powerful right up until the second it breaks. And when it breaks, the damage does not stay contained. It spreads. That is what made Lehman Brothers one of the most devastating collapses Wall Street had ever seen. If you want more breakdowns on the biggest corporate failures, frauds, and financial disasters in history, subscribe and watch the next video. Because behind every giant collapse, there is always a deeper structural weakness hiding underneath the surface.